Welcome to the deep dive. It's Thursday, May 14th, 2026, and I'm really glad you're joining us today. You know, when you first look at a financial chart, there's this expectation of mathematical precision.
Oh, for sure. It looks like a blueprint.
Right. It looks like an architectural blueprint. You see the grid lines, the exact prices, the perfect little red and green candles just marching across the screen.
Yeah, it looks like a pure, clean numbers game.
Exactly. But then you actually put your own money on the line, and suddenly that blueprint just catches fire. You realize you aren't looking at a math equation at all.
No, not at all.
You're looking at a battlefield. It's messy, it's chaotic, and it is entirely driven by human psychology.
And that illusion of order is what traps so many people. We look at charts and we try to find this geometric certainty that simply doesn't exist.
It's just not there.
Right. So today, we're tearing down that illusion. We're decoding the RSI and EMA strategy, not as some set of rigid math rules, but as a lens to observe two constantly warring factions.
Okay, let's unpack this, because this is where it gets fascinating.
It really is. You have the emotional, reactive panic of the retail crowd on one side, and then you have the silent, heavy footprints of institutional smart money on the other.
Yeah.
Because the hardest truth in trading is that most people, they don't lose their capital because they lack technical skills or don't understand an indicator.
Right. They lose because they're fighting their own biological wiring.
Exactly. They are fighting human nature.
So let's look at the retail side of the battlefield first, because that biological wiring creates a brutal repeating loop. We see this play out constantly.
All the time.
Picture the everyday trader sitting at their laptop. They see an asset going on a massive run. Long green candles, price pushing higher for days. What happens?
FOMO. The fear of missing out.
Yes, FOMO kicks in. And it's a visceral, painful emotion. So they buy right near the top because the psychological pain of sitting on the sidelines while everyone else seemingly gets rich just becomes unbearable.
And the market, being this incredibly efficient mechanism for inflicting maximum psychological pain, immediately begins to shift.
Of course it does.
The momentum stalls. The price starts to bleed out.
And then the panic sets in. They watch their position go red. They hold on, hoping for a bounce, but the drop just accelerates.
Yeah. And finally, they reach their breaking point.
They hit the sell button. They capitulate exactly at the bottom. And as if the market is playing this cruel, targeted joke on them, the moment they sell,
The price instantly reverses.
right, it shoots back up. They're left sitting in the dust, having sold at the exact worst moment. So what do? The cycle restarts. They FOMO back in at a higher price.
Well, and this cycle isn't an accident. It's a structural feature of the market. If we connect this to the bigger picture, experienced, well-capitalized traders operate in a reality that's completely detached from that emotional loop.
They're not feeling the FOMO.
Not at all. They understand that trading is, at its core, a mechanism for the transfer of wealth from the emotional and reactive to the patient and disciplined.
Wow.
Yeah. If a candle is running away green, the professional lets it go. They never chase. They wait patiently for a state of extreme market imbalance.
Wait, imbalance? When I think of imbalance, I picture order books tilting heavily to one side. But you're talking about an emotional imbalance, aren't you?
Yes.
So you're saying the smart money is actually hunting for the exact moment of retail capitulation we just described.
Think about the mechanics of moving large capital. A market maker or, an institutional player with tens of millions of dollars to deploy, they can't simply click buy on an exchange.
Right, because if they do, they'll instantly shoot the price up and give themselves a terrible entry.
Exactly. To buy a massive amount of an asset without moving the price, they need an equally massive amount of people willing to sell to them at that exact moment.
They need liquidity.
They need liquidity. And the easiest place to find a massive tool of desperate sellers is during a panic.
So you're saying a trading chart isn't really a math equation at all. It's just an emotional endurance test. It sounds like retail traders are basically paying a panic tax to the professionals.
A panic tax. That is the perfect way to phrase it.
Because the everyday trader does all the stressing, all the reacting, all the sweating, and the professionals just calmly collect the premium by stepping in when the everyday trader can't take the pain anymore.
Every time you buy out of greed or sell out of fear, you are paying that tax to someone who is executing a pre-planned strategy.
That's brutal.
It is. To stop paying that tax, you have to stop looking at the price action as a reflection of an asset's fundamental value and start looking at it as a map of human behavior. You have to learn how to track where the professionals are patiently waiting to collect.
Which brings us to the first major tool in decoding this map, the exponential moving average, or EMA. Because if emotion is the problem causing this panic tax, we need a way to track the rational structural moves of smart money.
Right, we need to find their footprints.
But I want to be clear here, because when I first started looking at moving averages, I just saw squiggly lines trailing the price. We need to look at the EMA as an institutional footprint.
Yeah, so simple moving average, an SMA, just takes the closing prices over a set period and divides them equally. It's a blunt instrument.
Okay.
The exponential moving average, however, applies a heavy weighting to the most recent price data.
Got it.
In highly volatile environments like crypto or tech stocks, what happened over the last 3 days is vastly more relevant to institutional positioning than what happened 3 months ago. The EMA reacts to shifts in capital flow much faster.
So it defines the context of the battlefield. It doesn't predict tomorrow's price, but it tells you whether you're fighting on higher ground or lower ground.
Precisely.
Trying to buy a dip in a structural downtrend where the EMA is angled sharply down is just volunteering to be exit liquidity for someone else.
That's why the layered system is so crucial here. We aren't just looking at one line. We are looking at a 3-tier safety net. You have the EMA 9, the EMA 21, and the EMA 50.
Okay, let's break those down.
The EMA 9 tracks short-term momentum. It hugs the price closely and tells you if the immediate buying pressure is intact.
Then the 21.
The EMA 21 is the midterm pullback zone. It's the first major dynamic support level in a trend.
And then there's the EMA 50, which the source material calls the absolute anchor of this entire strategy.
Yeah, the 50 represents the main overarching trend.
So a robust, healthy uptrend, the kind of environment where we actually want to deploy capital, is what we call a layered structure.
Right.
The 9 is physically above the 21 is above the 50, and the price is riding on top of all of them. It's a visual staircase of sustained institutional buying.
And as long as that staircase structure is intact, the broader trend is bullish, regardless of what the chaotic short-term price action is doing on any given day.
But here's where it gets really interesting and where the psychology completely inverts. Let's say we have that beautiful layered uptrend. Everything looks incredibly bullish. Then, out of nowhere, a massive red candle prints on the chart. The price drops 15% in a matter of hours, slicing straight down to the EMA 50. Now, my immediate instinct when I see my screen flash red like that is to panic sell.
Naturally.
It looks like the floor is collapsing. So how does a pro look at a harsh drop to the 50 EMA and see a discount rather than a disaster?
Because the professional understands where retail traders place their safety nets.
Oh, the stop losses.
Exactly. In a sustained uptrend, everyday traders get complacent. They buy in, and they place their stop-loss orders just below the recent price action to protect themselves. Over time, massive clusters of these stop-loss orders build up.
Like a powder keg.
Yes, and institutional algorithms can actually see these clusters of liquidity.
So the algorithms intentionally push the price down to trigger those stop losses. That's insane.
They initiate a cascade. A sudden, sharp drop triggers the highest stop losses, which creates forced selling, which drops the price further, triggering the next level of stop losses.
It's a total chain reaction.
Exactly. To the untrained eye, it looks like a market crash. But structurally, as long as that price is hitting the EMA 50 and holding, the overall trend hasn't broken.
Wow.
The market is just violently shaking out the weak hands, the FOMO buyers who got in too late and put their stops too tight. The smart money uses that cascade of forced retail selling to fill their own massive buy orders at the EMA 50 at a steep discount right before the trend resumes.
So the EMA 50 is essentially the battle line where the institutions step in to say, okay, the purge is over, we're taking control again.
Exactly.
That makes perfect sense for tracking the smart money. But that raises a completely different problem. We know where the smart money is hiding at the EMAs, but how do we know exactly when the retail crowd is vulnerable enough for the pros to strike?
Right.
A drop to the EMA 50 is just a location. We need to measure the emotional intensity of the drop to know if the capitulation is actually complete.
And that is exactly where the relative strength index, the RSI, comes into play. Though I have to say, we have to completely discard the way most people are taught to use it.
Oh, absolutely. The traditional textbook definition is worse than useless. It's actively dangerous.
It really is.
Most people learn this incredibly rigid mechanical rule. If the RSI goes over 70, The asset is overbought, so you must sell. If it drops under 30, it is oversold, so you must buy. I mean, I know people who literally just run bots based on those two numbers and wonder why their accounts slowly evaporate.
Using RSI as a simple overbought or oversold binary ignores the actual math behind the indicator.
Yeah.
RSI does not measure how far a price has dropped. It measures the speed of the momentum change. It measures the velocity of the buying versus the selling over a specific period.
Which means an RSI plunging below 30 isn't just a signal that the asset is cheap. It is a psychological reading.
Exactly.
It means the selling pressure has reached an absolute extreme velocity. It is the visual representation of capitulation.
Yes, the everyday crowd has lost all rational thought. They are cutting their losses en masse, and the market is in a state of sheer short-term hysteria.
It's the emotional thermometer of the crowd. And under 30 means the thermometer has shattered.
But what's fascinating here is the critical trap that destroys so many portfolios. In a true structural downtrend, meaning the EMAs are crossed downward and the price is buried below the 50 game, the RSI can plunge under 30 and it can stay there for weeks.
Yes. Using RSI to buy just because it's under 30 is like running into a burning building because the smoke alarm went off without checking if the fire department is actually there.
That's a great analogy.
You're just catching a falling knife. Trading against the EMA trend just because you have a low RSI reading is like trying to swim upstream in a raging river.
A low RSI just means you found a temporary little eddy in the water where things seem calm.
But the overarching current of the river, the EMA trend, is still going to sweep you over the waterfall.
Exactly.
The math allows for prolonged extreme readings. Price can keep making lower lows, dropping another 10, 20, 30%, while the RSI just flatlines at 20.
Because the momentum is consistently negative. Right, so the indicator stays pinned to the floor while your capital vanishes. You can never, ever use the RSI in isolation. You must have the EMA trend filter to survive.
You're hunting for a high-velocity emotional pullback inside a broader structural growth narrative.
Exactly.
All right, so we've mapped the battlefield. We have the structural logic from the EMAs. We have the emotional exhaustion from the RSI. Let's actually execute the strike. How does the source actually combine them into a concrete strategy?
Well, we approach it through a strict swing trading framework, utilizing multiple time frames to filter out the noise of intraday volatility.
Okay, so where do we start?
You start on the daily chart, the D1. This is your compass. You're looking for condition 1. The trend must be structurally pristine.
Meaning the EMA 9 is above the 21 is above the 50, and the daily candles are opening and closing above the 50.
Yes, and if this daily structure is broken, you simply close the laptop and walk away. There is no trade.
You don't try to force a setup in a choppy market. You demand a clear trend. Okay, so the daily chart gives us permission to look closer. Then we zoom into the 4-hour chart, the H4, to pinpoint the actual entry.
Right. On the 4-hour chart, you monitor the price as it retraces back toward the EMA zones. A pullback to the EMA 21 is a sign of an incredibly aggressive uptrend.
Because the buyers are stepping in early.
Exactly. A deeper pullback to the EMA 50 offers a much more lucrative risk-to-reward ratio because you're buying at a steeper discount, but it tests the absolute floor of the trend's validity.
And while the price is dropping into that EMA zone, we are watching our panic thermometer, the RSI. Now, the text details 2 distinct ways this can play out. The first scenario is the smooth technical breather.
Yes.
The price dips to the EMA 21, and the RSI drops out of the high momentum zones down into the 35 to 45 range. It doesn't quite hit extreme panic.
That 35 to 45 range is the hallmark of a healthy market absorbing profit-taking. Early buyers are selling some of their positions to lock in gains, which causes the price to naturally retrace. But there is no mass hysteria.
It's orderly.
It's orderly. When the price hits the EMA and the RSI bounces from that 40 level, it usually results in a very stable, sustained continuation of the trend.
But scenario 2 is the one that really tests your nerve, the panic reversal. This is that violent liquidity sweep we talked about earlier.
Yeah, this is where it gets intense.
The price drops like a stone, slicing through the 21 and violently tagging the EMA 50. Simultaneously, the RSI crashes below 30, signaling maximum market hysteria.
To validate this specific setup, you need to see 2 very specific things happen at the EMA 50. You need a massive spike in trading volume, indicating heavy institutional participation, and you need to see long wicks forming on the bottom of the 4-hour candles.
Those long wicks are fascinating because they tell a real-time story. A long wick on the bottom of a candle means that during that 4-hour window, the price was pushed way down, the market was bleeding, panic was peaking, but before the window closed, immense buying pressure stepped in and drove the price all the way back up.
It's a visual record of a battle being won by the buyers.
It is. But wait, hold on. I want to push back on the actual entry trigger here. The source says I shouldn't buy at the moment of maximum panic.
Correct.
But if the price is plummeting to the EMA 50 and the RSI is dead bottom at 20, why am I supposed to wait for a quote-unquote confirmation candle, like a pin bar or a bullish engulfing? By the time a big green reversal candle finishes forming, haven't I missed the absolute bottom and lost a massive chunk of my potential profit?
You are absolutely giving up profit margin by waiting. But you are trading that margin for something infinitely more valuable.
Which is?
Structural proof. Indicators aren't enough. Price action is the final boss. You do not buy the exact moment of panic because you have no way of knowing if the capitulation is over. A falling market can always fall further.
That's true.
The institutions might decide to sweep the price 10% lower just to trigger another massive cluster of stop losses.
So trying to catch the exact bottom is just an ego play. You're trying to prove you're smarter than the market.
Precisely. It is ego over probability. You wait for the next candle. You don't buy the panic candle. You buy the next candle, which is the actual footprint of smart money stepping in to fight back at dynamic support. You wait for those specific formations because they are the literal mathematical proof that the institutional algorithms have turned back on and are actively defending that dynamic support level. You pay a premium to guarantee that the smart money is actually fighting on your side.
I love that. You're letting the institutions kick the door open and clear the room before you walk in. You let them take the blunt force of the risk.
Exactly.
But even with all of this, even if you have the perfect layered EMA structure, extreme RSI panic, and a beautiful textbook confirmation candle, there is no such thing as a guaranteed trade.
Never.
What happens when the market decides to break the rules? The market is perfectly capable of invalidating a flawless setup just to humble you.
Which is why strategy without risk management is just gambling with extra steps. Market makers know that retail traders look for confirmation candles too. So even after a beautiful bounce, the price might sweep lower one more time just to shake out the impatient money before the real rally begins.
It's a ruthless environment.
It really is.
So how do you survive that ruthlessness? What are the hard rules in the text for managing the trade?
Well, the moment you enter the trade, a stop loss must be placed below the lowest point of your confirmation candle, or safely tucked beneath the EMA 50. This is non-negotiable.
Right.
If the price breaks below that line, your thesis was wrong, and you take the small loss before it becomes a catastrophic one.
And what about profits?
Your take profit target should be scaled out at previous resistance levels. But the golden rule of the entire framework is the risk-to-reward ratio. You must demand a minimum of 1 to 2. For every dollar you risk losing if your stop loss is hit, the chart must logically offer at least $2 of profit if it hits your target.
But what if the nearest major resistance level is too close and the ratio is only 1 to 1? What do?
You walk away. If it's less, you walk away. Professional traders reject the vast majority of the setups they see.
That brings up a critical point about knowing when to walk away. How do you distinguish between a deep, scary pullback that is offering a great entry and a bull trap? You know, a situation where it looks like a temporary dip, but the underlying narrative has actually fundamentally shifted.
Well, the market will always give you invalidation signs. The problem is that most traders are too emotionally attached to their position to read them.
True.
If the 4-hour candles start repeatedly closing solidly below the EMA 50, that is your first major alarm. The dynamic support has failed.
Okay, so it closed below the 50. What else?
Furthermore, if you see the short-term EMA 9 cross underneath the EMA 21, the short-term momentum is completely fractured.
And what about the RSI in that scenario? Does it just stay low?
Yeah, if the RSI dips below 30, tries to recover but gets instantly rejected and slammed back down, it means the capitulation wasn't a temporary sweep, it is the sustained institutional exit.
Oh, wow.
When you see those signs, the layered structure is dead. The narrative has shifted, big money is exiting, and the strategy is void. You do not hold, you do not hope, and you absolutely do not buy the dip.
So what does this all mean for you, the listener, the next time you open up a chart? We've navigated through the layers of moving averages, the velocity of momentum, the mechanics of liquidity sweeps. It all boils down to a brilliant synergy.
It really does.
The EMA gives you the cold, calculated logic of the money. It tells you where the structural framework holds. The RSI gives you the raw, unfiltered emotion of the crowd. It tells you when the panic is ripe.
Exactly.
When you wait for them to agree, you stop reacting to every random green or red candle that flashes on your screen. Most importantly, you permanently stop paying the panic tax.
That is the ultimate revelation here. The most lucrative opportunities in financial markets do not happen on clear, sunny days when the macroeconomic outlook is perfect and everything makes sense. By the time everything makes sense, the move has already happened.
Right.
The real opportunities happen in peak chaos. They happen exactly when the crowd panics and the professionals step in to execute a calm, predetermined plan.
Yeah.
This framework isn't a magic formula for predicting the future. It is simply a tool to help you see clearly through the smoke of a battlefield.
Blueprint versus battlefield. We started by saying a chart looks like clean math, but it's really a messy landscape of human emotion. But reading through all these mechanics, I'm left with one final, slightly unnerving thought.
Oh, what's that?
This entire strategy relies on the predictability of human panic. It relies on everyday people making irrational decisions when they see red on their screens.
Yeah, that's the core of it.
But as frameworks like the RSI and EMA become more universally understood, and as massive algorithmic trading bots are programmed to execute these exact liquidity sweeps and front-run these setups in milliseconds, how will the market adapt?
That's a great question.
What happens to the quote-unquote emotion of the crowd when the crowd eventually consists almost entirely of cold calculating machines trying to outmaneuver each other's fakeouts? Will the algorithms just end up artificially inducing panic in each other?
It's entirely possible.
It is a wild frontier out there, something to mull over the next time you look at a perfectly clean chart and wonder who is really pulling the strings. Thanks for diving deep with us today.